The United States and China, the two largest economies in the world, are engaged in what is rapidly becoming not only the biggest trade dispute in recent history, but also a growing financial conflict with global consequences. What began as a tariff war has evolved into a broader economic struggle involving currencies, debt markets, and strategic financial maneuvers that could reshape the global financial landscape. At the center of this conflict are escalating tariffs. The United States has imposed a series of steep tariffs on Chinese imports, while China has responded with retaliatory measures on American goods. This tit-for-tat escalation has reached levels that many economists say will eventually hurt both sides. As these tariffs climb, their impact extends far beyond the shipping ports and into the heart of each nation's economy. One possible response from Beijing has sparked particular concern among analysts: the potential devaluation of the Chinese yuan. Allowing the yuan to weaken would help make Chinese exports more competitive and offset some of the damage caused by U.S. tariffs. However, such a move comes with major risks. A sharp devaluation could trigger a chain reaction, leading to capital flight from China, a scenario the country has seen before. In 2015, after a surprise yuan devaluation, nearly $700 billion in capital fled China within a single year. That event rattled global markets and put immense pressure on the Chinese government to stabilize its currency and prevent further outflows. Today, with the Chinese economy already under stress from declining growth and reduced consumer spending, a repeat of 2015 could be economically devastating. Policymakers are therefore reluctant to pull this lever unless absolutely necessary. That's not the only tool China might use. Another significant weapon in its arsenal is its vast holdings of U.S. Treasury bonds. China is the second largest foreign holder of U.S. debt, with around $761 billion in treasuries as of early 2025, just behind Japan. Recently, reports have emerged that China sold $50 billion of these bonds in mid-April. Analysts suspect this could mark the beginning of a broader strategy to gradually offload more of its holdings, with the ultimate goal of pressuring the U.S. by raising its borrowing costs. This tactic is not without precedent. Since 2017, China has sold roughly a quarter of its U.S. Treasury holdings. The logic behind such a move is simple: by reducing demand for treasuries, their prices fall and yields, or interest rates, rise. Higher yields mean higher borrowing costs for the U.S. government, which is already grappling with a large and growing national debt. However, this strategy carries significant risks for China as well. Most of its $3.2 trillion in foreign exchange reserves are denominated in U.S. dollars. A sharp drop in the value of the dollar or U.S. bonds would reduce the value of China's own assets. In effect, Beijing would be hurting itself while trying to hurt Washington, and yet, even with these risks, the economic standoff continues to escalate. Both nations are digging in. In April 2025, the U.S. raised tariffs on Chinese goods to a record 145%. China responded by hiking its own tariffs on U.S. imports to between 84% and 125%. Chinese President Xi Jinping declared that there is no winner in a tariff war, but also made it clear that China would not back down. The consequences of this standoff are becoming increasingly visible across both economies. In China, small and medium-sized businesses are bearing the brunt of the damage. Orders from the U.S. are being cancelled due to high tariffs, and warehouses are filling up with unsold goods. Ports in major export hubs like Guangdong and Shanghai are experiencing serious congestion, with containers piling up and shipping delays growing. Online, Chinese business owners are voicing their frustration. Many report factory shutdowns and unpaid worker furloughs due to a lack of orders. Seasonal industries such as Christmas decorations are especially hard hit, as the U.S., which normally accounts for nearly 90% of Chinese Christmas export orders, is backing away due to price spikes. The cross-border e-commerce sector is also under immense strain. According to Wang Xian, president of the Shenzhen Cross-Border E-Commerce Association, the new tariffs are an unprecedented blow. Thousands of Amazon sellers and online retailers are now looking for ways to survive. Some hope to pass on the cost to American consumers, while others are desperately seeking alternative markets in Southeast Asia and Europe, but moving production abroad is not simple or fast. While some companies are exploring relocating factories to other countries, the uncertainty surrounding trade policies has made businesses hesitant to invest heavily in new facilities. At best, the moves are cautious and small-scale. With limited capacity and uncertain outcomes, meanwhile, U.S. policymakers are negotiating new trade partnerships with 75 countries to diversify their supply chains away from China. This strategic realignment could further isolate China's economy if successful. The U.S. continues to hold an advantage in technology, capital markets, and global influence, areas where China still lags behind despite decades of growth. Behind the scenes, U.S. strategy under President Trump seems aimed at forcing a long-term decoupling from China. The belief is that an economic war is already underway, and that tariffs and financial pressure can weaken China's global ambitions. Some speculate that recent moves, like forcing Chinese firms to delist from U.S. stock exchanges, are part of a broader effort to reduce economic entanglement. As for China, its response is shaped not just by economic needs but by political ideology. Since 2012, Xi Jinping has promoted a more assertive foreign policy known as wolf warrior diplomacy. It is rooted in the belief that the East is rising and the West is declining. Within this worldview, confronting the U.S. is seen not as reckless, but as necessary for China to claim its rightful place as a global leader. This narrative, however, often overlooks the economic pain felt by ordinary Chinese citizens. With factories closing, jobs disappearing, and prices rising, life is becoming harder for millions. Yet Xi's focus remains fixed on political image and long-term goals, even if it means enduring short-term pain. The financial standoff between the U.S. and China is far from over. As each side tests the limits of the other's endurance, the world watches anxiously. What began as a dispute over tariffs has morphed into a larger, more dangerous game of economic brinkmanship. And in this game, no one walks away unscathed.